Here we go. Welcome to the VCTV panel on early stage investments and seed capital. I have a wonderful panel here. We are missing
Chris,
Kyle Elliott, who's the usual host. But
Haziran
we
güzel.
have a very interesting panel here. I would like to, my name is Raghu Rao. I'm from Princeton, New Jersey. I'm an entrepreneur, serial entrepreneur, investor, and strategic advisor. We would like to get a good idea of the landscape for early stage investments as well as what goes into these investments from our co-host here. First, I will go around and do a round of introductions. So maybe we'll start with Jason. Maybe a little bit about your background, where you're located, and how you're interested in this early stage. Please, others, mute yourself if you're not on the talking. Thank you. Go ahead, Jason.
Great. Welcome. Glad to be back here. It's been enjoyable being a part of these discussions over the last year and a half. My name is Jason Jacobson, managing partner of Propellant Ventures. We're about boldly investing and empowering the future. We are focused on investing in pre-seed and early seed companies throughout the Midwest part of the U.S. We are focused on B2B business models such as health tech, fintech, ed tech, supply chain, and future work. Personally, I've been involved in the entrepreneurial and investor community for 20 plus years throughout the Chicagoland area. It does expand nationwide and worldwide, but my backyard is the Chicago area. And one thing also is I manage the Chicago chapter of the Founder Institute, which is the world's largest pre-seed technology accelerator. I've been running the Chicago chapter for 10 years, and we're finishing up our 14th cohort in a couple of weeks. So it really keeps me grounded in the early stage investment and entrepreneurship community. So glad to be back.
Thank you, Jason. I'll come back to the Founder Institute. I think that's very important enablement platform like that. So we'll talk a little bit about that. Let me go to Ingo Dahm next with some Germany. I think the first time I'm meeting him, and I don't know if this is his first VCTV show. Ingo, a little bit background and how you got involved in early stage investing.
Yeah, thank you so much for inviting me here. I'm Ingo, and I studied electrical engineering and made my PhD in artificial intelligence. And I'm very interested in using modern technology in order to scale impact. And impact for me means education, health, and climate technology. And this is what we are doing. We, on the one hand side, invest in early stage startups, mainly Europe, often Germany, in those areas, education, healthcare, and environment technology. On the same hand, we provide a kind of fintech approach in order to help others to invest in startups, even with very, very small ticket sizes in a quite modern way. That's what we are doing.
Okay, thank you so much, Ingo. Harsh, a little bit background. I know you are a veteran on VCTV, so a little bit of background on how you got into early stage investing.
Absolutely. Thank you so much, Raghu. It's great to see you after a long time. Great to be a part of this panel as well. Short intro about myself. I'm a VP at our Ventures. Essentially, we are an early stage investment company where we help startups raise funds all the way from 200 to 50K all the way up to $10 million. We do a lot of angel syndicates as well as micro VC, facilitate a lot of micro VC and VC investments, and we are open to all sectors, technology focused, right? Whether it be fintech, marketing tech, SaaS, clean tech, etc. And currently, I'm working a lot in the clean tech space because I believe that is going to be the next future for the coming decade or two. So, looking forward to have some amazing discussions. Thank you.
Thank you. Now that you talked about the areas of investment which are hot, that Harsh started off. I think Harsh mentioned clean tech. I think Ingo mentioned a couple of areas as well. I know a lot of you are not necessarily sector specific. Some of you are sector agnostic. How do you approach investments? Is it mostly inbound, or do you look specifically? I know Jason, for instance, has the enablement platform, Founder Institute. I would like to know from each of you how you are getting your deal flow. Is it how much of it is inbound? How much you're reaching out? Do you have enablement platforms such as accelerators and things like that? How closely do you work? Maybe Jason, you can start out and tell us a little bit more about Founder Institute as well. So.
Yeah, so as I mentioned, I've been active for the last 20 years in the startup ecosystem. So I have a pretty established network of all different players in the ecosystem. So a lot of my deals just come through the network, whether it's angel investors that send me deals they're a part of, whether it's other entrepreneurs that maybe it's their new company or they know the founder of another company, as well as service providers, accountants, attorneys, banks, those types of sources, traditional sources I know for many investors, but a lot of it is inbound. I'm not as proactive right now as I don't need to be because a lot of it comes our way. Also, we have an online submission on our website. We do get stuff coming weekly on that as well, but the ones that mostly get the higher priority are the ones coming from trusted sources. Mm-hmm. It's amazing though that a lot of people that submit on our website don't even look at our thesis. We're Midwest focused. We get many deals from around the world, and we're B2B focused. We get many deals that are not B2B focused. So the bulk of them come from the network. Also, the Founder Institute is a good source as well. So for those that aren't familiar with it, it's a 4-month pro accelerator to assist idea stage, early product development, early market acceptance. But either way, it's pre-seed founders and their companies to build a company. And it's pretty tough. Only 20-30% finish the program. And most are part-time on their businesses. We only have a few that are full-time as they go through it, but within 6 months, we encourage them to quit their day job and work on it full-time if they're serious about it. So we do have, I've personally been running it for 10 years in Chicago, so there's a deal flow there, but I'd say the bigger deal flow right now is the mentors. Our mentors are all seasoned tech entrepreneurs. Many of them started more than one company, so we have access to them, early on for their next companies. So far, we've made several investments. We have one mentor company we invested in, as well as one graduate company. So it's a natural deal flow source, but again, it just comes from a lot of relationships that I personally and we as a fund have built over the last 20 years. We also get deals from the other VCs as well, and so as we continue to have more money to invest, we'll be even more proactive and target certain deals. But right now we have a pretty good deal flow source just from the various sources I mentioned. So I feel pretty good about it. Yep.
I think the important thing for the entrepreneurs to note is that make sure before you go to an investor, you at least check out their thesis and go to their website and understand what their interests are and what areas they invest in, ticket size and stage and everything. So I think very, very important to do the due diligence. So Ingo, maybe you can talk a little bit about the landscape in Germany in terms of the early stage investments. What size investments do you do, and what are the hot areas? And also, how is the deal flow happen for you? I mean, how are you engaged with the startup community?
So in Europe and Germany specific situation is a little bit different compared to US because there's significant lower amount of money, and there's something that we call the Valley of Death. And this is the area between the typical business angel ticket size, which is in Germany roughly 50K, and the Series A investors that typically invest $1 million or something. So in the seed phase, we suffer from a lack of money. And this is exactly where we focus because this is a specific and special niche. And we invest between 200 and 500K in the startups in that phase. And the question, how do they come to us or how do we find them is, I think it's similar all over the world. You can have references and the founders come directly to you or something similar. But we developed something that is a little bit different to others because we engage a sophisticated AI here that helps us to screen the startups super fast. It takes us, including getting all the data, less than a minute, 39 seconds.
How do you get the data? Is that an application form, or how do you?
Yes, it's an own developed application. And it's a self-service. They enter their data, and moreover, we engage a park of crawlers, and we use existing databases that typically all VCs know, and we bring all this data together. And at the end of the day, we send 8 to 10 pages PDF document to the founders and tell them what we think and why we think they are worth. And in the early stage, this is very interesting material for them, because they often in the very early have no clue about the value of their company. Are we worth 1 million or 10, something in between? We don't know, and we can help them. And this is becomes a major reason why people come to us in order to just get the evaluation, and we can have a very quick selection process and invest in roughly 0.8% of the founders that come to us in order to get that kind of information from us.
Pretty good, sifting mechanism here. Looks like so less than 1% of the applicants, right? So that's must be pretty. So that's great that you're using AI to do that. I think we'll see more and more of that. I think also it's about what kind of data you have available to be able to do that as well. So Harsh, maybe you can talk a little bit about the scene in India, and also you're involved in multiple areas reaching out to the startup community. How you reach out and how people should reach out to you as well.
Absolutely. So there are definitely a lot of channels for me, right? My LinkedIn social media is quite active. I get a lot of inbound from there. Apart from that, I get a lot from Facebook as well. People are simply dropping in messages. Just I think last week I got someone who was raising his VFunder campaign and wanted to connect with my investors who could invest in his VFunder campaign. So LinkedIn, Facebook are working very well. Apart from that, I'm connected with a lot of early stage incubators in India, which are associated with universities, right? So IIT Bombay is one of the very reputed incubators over here. Somaiya College has a phenomenal incubator. A couple of other incubators from Gujarat State, they kind of reach out to me. So I get a lot of deal flow from there as well. Apart from that, our Ventures is a very recognized brand across India. So even for them, getting like 20 deals every week it's quite normal. So there's literally no shortage of deal flow. Essentially, primarily the time goes in terms of, as Ingo was pointing out, the sifting it through, right? Kind of curating the best ones. That is where most of the time goes. Deal flow is not a challenge whatsoever.
Thank you, Harsh. So I thought I'd like to know a little bit more about the size and the amount, the ticket size, how much they're raising, as well as what valuations. I know it's different in different geographies. And how does the early stage founder come up with what valuation should be raising it, and what is the right size? What kind of runway should they expect? Maybe Harsh, you can go first, and then we'll go to Jason and Ingo.
Absolutely. So there's this, I'm not sure if it's across the world, but there is a very weird trend which is just coming these days, where even at the pre-seed level, founders are expecting that they'll get funded, right? Even for small checks like 50K to 100K, that amount is not significant at all, right? To kind of have a significant investment, it's at least needs to be like 200 to 50K. But what's tend to happening is the founders aren't kind of investing any of their own money, and even for like 50 to 100K, they reach out to us for investments. Not just us, other angel networks which are there in India. India has tons of angel networks, right? Even for those kind of short amounts. So that has kind of created a weird trend where even when you don't have an MVP in place, forget about product market fit, even when you don't have an MVP in place, startups are expecting they'll get funded before kind of proving the traction, before doing any form of market research. So this is a bit of an uncomfortable situation where you ask me, because unless the founder has devoted his own time and money into the business, we do not feel that he has that kind of commitment towards the venture, right? We need to see that how much of his skin is in the game, how much of his time. If he's doing his job on the side and then he's reaching out to us, he's telling us, you invest 50K, 100K into my business, I'll quit my job tomorrow. Why should I care? If you're not committed yourself, why would an investor invest in your business? So that is a very uncomfortable situation which has happened, especially over the last 1 year.
Yeah, the accelerators are helpful there, I think, as Jason was mentioning, where some of them are not yet full-time. And maybe the initial process helps them navigate into where they can come in all in. But absolutely, it's important that they're all in, because if like investors are committing their funds, we want the at least someone on the team, has to be full-time. Otherwise, it doesn't work. So Jason, maybe you can talk. Yeah, go ahead.
Absolutely, and FI is actually doing very, very good in that regard, right? You can still do your job and still do those 12 to 16 hours a week, course curriculum for FI. It's phenomenal in those terms.
Yeah, I think it works, but at least one primary member has to be full-time. Otherwise, I think it doesn't have enough focus. And others
Agreed.
need to be ready to jump when they have the resources available. So Jason, maybe you can talk a little bit about how the Founders Institute helps those people who are trying to manage their risk, right? And how you get them to go all in, and get it set up so that they have a good chance of success. We all want the ventures to fail early so that the investor money is not wasted, right? But at the same time, we want the entrepreneurs to have a good shot at knowing what is in front of them, right? In terms of risk and how they should figure out their risk. So maybe you can talk about that, Jason.
Yeah, so as we discussed, the Founder Institute is designed to be part-time while founders still have day jobs. Now, we do have several full-time founders that are all in when they join, but we also believe that they can start to build it while they still have their resources, such as a salary, to support building their company. So we put them through a lot of tests. They are working 20 hours a week on average on the business based on the assignments we give them. We want them to spend a lot of time on doing customer development research, making sure that there actually is a product market fit for what they're trying to do. We make sure that they incorporate their company by a certain time in a proper corporate structure. We have all these checks and balances that some founders, when you ask them to incorporate, it makes it real for them, and some drop out of the program because they're not ready to do that. So there's a natural weeding out mechanism, but we also do drop founders as well if they don't hit certain milestones. And so we want the most serious, committed founders to actually build a company in the structure of our program. Doesn't mean they still can't be successful if they drop out. There's many stories of that has worked well, but our program really is a launching pad for many founders to jump off that cliff, so to speak, and actually want to build a company. And we put them through. It's a tough program, and those that are serious will continue building it after. And so we mitigate some of the failure or the risk in the beginning because we put them through the steps they need to take to build a company, and we get them set up for growth, but they have to do the work. If they don't do the work, they're not going to get out of what we want them to get out of. And they put in they get out what they put in, but this is real. This is not academic. It's real world. We want them to build a company. And so, we don't have a huge percent that finish because this becomes real. Life gets in the way sometimes too. Many have families, many have day jobs, things happen, and that's fine. I mean, they may have to take a pause and they come back later to build it or build at a slower pace. But many of our mentors are also investors. They've had successful exits of their companies, so now they're investors. And so we introduce them to individuals that could be supportive in the future, whether as an advisor or an investor, but we put them in the right structure and mindset to continue to build the business if they're serious enough about it.
Yeah, that's a great segue. The advisory, the team and the advisory roles, right? The team itself. So maybe, Ingo, you can talk a little bit about what you think are needed from a early stage venture in terms of a team. What are the different talents, and does everything have to be full time, or can some of it come from fractional or advisory roles? What is your what have you seen in that regard?
That's a complicated question because every startup is a different story. I would agree with Harsh and that they need to have a kind of skin in the game, first of all. So having a team consisting of 10 super nice, educated guys who just work 4 hours a week on this project won't be very successful in most cases. But team is not everything. Team is the second most important factor. The most important factor for a startup is timing. So timing, team, idea, business model, and what can I as investor bring in as an advantage that is more than money. And these are the 5 most important factors that you need to analyze very good and find out what really fits. What I miss most often in a founder's team is sales competency. There are many brilliant brains in the market that people who have a very good product feeling or think that they have a good product feeling, because what makes a product a great product is that people need that product and desperately want this product and want to buy it. And otherwise, it is just an idea. Selling and good marketing not in terms of branding, but marketing in terms of selling or preparing the sales, this is a skill that a great founder team differentiates from a good founder team. A good network is nice, but not always needed, because when you have very good investors, this is something that you can get as a inheritance from them.
What is the minimum team? I mean, what is like somebody full time? Who needs to be at least full time?
Well, it depends. There are very great single founder personalities, like, for example, in our world, Elon Musk or Steve Jobs. They are single founder personalities, and they know how to find good guys that surround them and build something great with them together. But apart from that, I would say that a good founder team needs, let's say, 3 to 4 people. This is a good combination. But as I already said, there are exceptions. There are single founder personalities, quite seldom, and there are founder duos that can be very successful as well. But in most cases, having 3 to 4 person is a very, very good start and gives you the opportunity to bring in technology, sales, human relations, and most importantly, not especially when the startup grows, process expertise, how to create something that really scales. And it's very seldom that a single person can be very excellent in all 4 disciplines as well.
Thank you. Thank you, Ingo. I think we're coming to the top of the hour. And what I would like to do is to kind of go around and get some closing thoughts. But I think, Ingo, as you very rightly pointed out, some kind of a methodology for strategy, including going all the way from seed to harvest, if you will, to exit, all the way, and maybe a 3-year strategic plan, 1-year, operational plan, and a 90-day execution plan, so that there is some level of long-term and also short-term thinking going into how you are going to be execution, the thing, right? So Harsh, maybe we can some closing thoughts, and then where people can reach you. I know you mentioned it, but one more time.
Sure. Thanks, Raghu. So definitely Ingo made some valid points over there, right? I particularly would not focus on single founder or multi-founder, because what typically tends to happen is we might feel that multi-founders have a diverse kind of skill set which can balance one another. But I have seen more companies kind of close down because of inter-founder conflict. So if you actually look at the success rate, you will find that single founders are just as successful as founder teams. because majority of the other founder teams kind of closed down because of internal founder conflict, right? So that is why I don't kind of use that as a barrier that, if a single founder is coming, I would not kind of count them out. I would still kind
It's
of,
more about awareness,
understand.
right? They understand their strengths and weaknesses, so bring the right resources.
Exactly. So that's extremely important. And even the other point regarding marketing, right? I have seen brilliant IIT graduates, coming up with amazing products. But when you ask them what your business funnel looks like, they say that we already have the funnel in place. And when I ask them, what kind of funnel, they'll have a landing page which connects to an email, and that's it. And they call it a funnel. That is not what a funnel looks like. Building a funnel, it's a combination of an art and science, and they don't understand it. The problem is they think they've just put on a landing page, and just on that they'll get some leads over there, and that becomes a funnel. It doesn't make sense. So there's a significant dearth of marketing knowledge out there, and I try to help the best I can, but sometimes they just stuck in their ways a lot. So I that kind of also kind of shows me that if they don't have that flexibility, it could become even further more problematic in the future as well. And that's why I kind of then take a step back.
So Harsh, I use something called Entrepreneur Operating System, which Gino Wickman came up with. Traction and Leap. He's author of 2 books, and that kind of gives you how to different types of capital, right? The obviously financial capital, intellectual capital, human capital, and also how to hire and fire A players, all these kind of things. There's a lot of issues, and the more experience, that's where the advisory board, I think, comes in, who can guide and fill the holes, that may be in there. So Jason, some closing thoughts and your advice to the entrepreneurs listening in.
Yeah, just to continue the conversation with Ingo and Harsh were talking about in terms of founders. Our fund specifically comes in early. We come in pre-seed or early seed. Many times we're the first VC or the only VC initially. So we'll invest alongside angels, angel groups, other VCs, of course. And at that stage, it's difficult to find several full-time founders. Now, we do want at least one person full-time for sure. And then other people around the table, even if they're part-time, but to fill in some of the holes, that's a sign of a good leader that you can bring in other people to fill in those holes. We realize that it's going to be part-time until you raise the capital, and that's okay. But as long as you have some of those other areas filled, that's important. But for sure, at least one founder needs to be full-time. So that's important.
Jason, where can people reach you?
Yep. Yeah. So people can reach me at Propellant Ventures at propellant.vc on LinkedIn, or my email is jason@propellant.vc. If you do email me or send me a note on LinkedIn, make sure to let me know where you heard about me so I can connect the dots and understand why you're reaching out to me. But happy to, I do respond to all emails and inquiries, so happy to take them. So thank you.
Thank you, Jason. Ingo, closing thoughts and how people can reach you and any advice you have, parting advice.
So my advice to founders is very simple. Try to sell your product before you build it. And my advice to investors, maybe that want to be investors, look for a partner that helps you to grow, and a partner that understands the geography, the region, and the local opportunities and challenges. You can reach me by going to my LinkedIn profile, Ingo Dahm on LinkedIn, or when you are a startup and want to know about the value of your business or about your startup, just go to signup.kapakura.de. And then we come back with a 8 to 10 pages PDF document. So that's my advice and my coordinations.
Thank you so much, everyone. I think we got some very interesting points for our listeners, and hopefully good luck to each of you in your ventures. And this is Raghu Rao, and I'm very happy to have had a chance to be part of this discussion. Thanks to La Token and VCTV. And see you all next time. Kyle Ellicott should be back with us shortly. So thank you so much.
Thank you so much.
Bye-bye, everyone. Thanks, guys.